Hello everyone and welcome to episode 15 of Ask Mortgage Mike, where I take topics and questions regarding the mortgage industry and try to help you, the viewer, answer some of those questions. So today we're going to go ahead and take a look at student loan debt. Now this question was posed to me by one of my Facebook viewers, and I want to thank you for that question. So I'm going to give you some statistics regarding student loans first off, and then we're going to go into how they affect your ability to apply for financing. So some of the stats, right now there's $1.3 trillion in student loan debt. Absolutely unbelievable, $1.3 trillion. 43.3 million Americans have student loan debt right now. The average student loan is outstanding for about $37,000 and has a monthly payment of $351. And there are 7 million people that have student loans that are currently in default. And default is the key word there, and we'll touch on that as we get through the episode today. So the first thing that we're going to discuss is kind of how student loans are changed by your loan program. So there are 5 loan programs, right? There's Freddie Mac, Fannie Mae, FHA, VA, and USDA. Now each one of those outlets, and then you also have portfolio where banks are lending their own money. We're not going to discuss any of those because those change by lender. So today we're going to talk about the 5 conventional, the 5 normal mortgage types that you get out there, and the way that student loans impact each of those. So for a Freddie Mac loan, now when you call to get your mortgage or financing, your lender, your mortgage guy, should be able to tell you whether it's a Freddie Mac, whether it falls into one of these categories. So a Freddie Mac loan has a minimum payment of 1% of the outstanding balance or the actual payment, whichever is higher. So if you owe $50,000 on student loans, your monthly payment is only $250. 1% of $50,000 would be $500. You would have to qualify for your mortgage based on $500 a month in payment to the student loans. So if there are 2 of you and you each have $50,000, now you're talking about $1,000 a month in debt that you have to assume, even if those student loans are deferred. Freddie Mac does not allow that. You cannot have a student loan in deferment. And so if you have a payment that's on the credit report and it says it's $250, doesn't matter, 1% of the payment. Fannie Mae is a little bit different, and this is the more popular of the programs. So Fannie Mae has you go with the actual payment on the amortized loan. So a lot of times, again, you'll have a payment that's on $50,000, it's $250. But if you do the math on that on a 10-year repayment or a 20-year repayment, that payment would never pay off the actual balance. At some point, the student loan will amortize again and your payment will go up. So on Fannie Mae, you have to use the fully amortized payment. So they'll come up with the interest rate that Fannie Mae has on, or that Sallie Mae or whoever the lender is on it has on the loan, and then they'll qualify you based on what the true payment should be based on you paying off the loan in 15 or 20 years or 10 years, however long the repayment plan is on the student loans. Or 1% of the outstanding balance also. So you got a couple of those, and they go off of whichever the higher payment is. FHA is 1% no matter what. It doesn't matter if your fully amortized payment is more or less, they're going to go off of the 1% of the outstanding balance. So I had a client the other week that had $120,000 in student loan, 1% is $1,200. Now that may seem like a lot, but up until about 6 months ago, that was 2%. So imagine people trying to qualify with a $2,400 a month student loan payment. The last one is VA. Now, VA has a benefit that nobody else has. VA will still allow you to have your student loans in deferment and then not count that debt against you. Now, the stipulation, though, is that VA requires you to have 1 year deferment left on your student loans from the time that your first mortgage payment is due. So if you buy a house and you close today, and your first mortgage payment's not going to be due until October 1st. If your if your student loans are deferred on a VA loan until October of 2017, then that would then allow you to qualify without having to count the student loan debt against you. Outside of that, VA uses the actual payment that's on your, that's by the servicer. So the actual mortgage payment, they don't do a 1%, they do the actual payment. The last one is USDA. Now, USDA is a loan program that's for rural properties or outside of the city limits. USDA requires you to have an actual payment set up with the student loan company provider, because a lot of times what student loan providers will do is they'll allow you to have a payment based on your current income in anticipation that your income increases later, and they'll bump up the payment. USDA will not allow that to happen. They want to see what the fully amortized payment is also. So again, these are some looks at some of those things. Now I went to the default, right? So the stat that I had was 7 million people are currently in default on student debt. If you are currently default, not delinquent, a delinquent is late. You can be late on student debt. It still has negative impact on your credit scores, but if you are in default, it may prevent you from ever buying a home. Now, there are always going to be those people that will do the one-off loans, where you're borrowing money from Uncle Tony in the back alley, right? There's going to be those people that are lend hard money, and you should be able to find financing with them, but it will eliminate you. There's a very huge possibility that you will be eliminated from getting a lot of traditional financing if you go default on student loan. Now, this is not private money, so if you go to your local credit union, you borrow money for, that's one thing. But if you go to Sallie Mae and you're in default, you're going to have a hard time getting financing. The other thing regarding student loans is Sallie Mae student loans cannot be included in a bankruptcy. You will have the debt for the rest of your life. There's no way to include it, no matter what hardship comes of you. It cannot go into a bankruptcy. Now, hopefully this changes in the future, but as of right now, your student loan debt, if it's coming from a government entity like Sallie Mae, it cannot be rolled into a bankruptcy. Now, again, if you borrowed money from a credit union and you file bankruptcy, that money may have the capacity of being rolled in. But again, I hope this answers some questions. I know we ran a little long today, a lot of information to cover on them. I hope everyone has a great week. If you liked the video, please give it a thumbs up and share also.